So what's up everybody, my name is Timothy and welcome to this YouTube channel. So today we shall be looking at introduction to points of interest. Okay, so guys, if you are someone who is interested in things to do with Forex, you want to learn about Forex, I'll urge you to like this video, comment and also subscribe so that you can be part of my notification people whenever I drop any content pertaining to Forex trading. So today is on 2nd of October 2025 and today I'm together with my student coach and I want us to learn together introduction to points of interest. So I hope you guys are ready and let's start the lesson for today. So yesterday we were covering about market structure and we looked at the advanced market structure. Okay, then after looking at the advanced market structure, we say that price starts with what we call a consolidation. Okay, we start with what we call a consolidation. Then we say that after price has consolidated, manipulated and then distributed, we said that price will deliver to a point of interest. So today we are asking ourselves that question. So what's a point of interest, guys? A point of interest is where orders are located. Okay, these are areas whereby orders in the market are located, and these are areas where also the big people, the big players in the market, the hedge funds, the banks, okay, these big people in the market, these are the places where they put their orders and they expect that if price reaches that level, okay, if price reaches that level, it's going to get a reaction or we are going to have some movement from that place. Okay, so why is it important for someone to be able to understand this point of interest? Number one, this Forex market has two players. We have people who are called the big players, okay, the big players, and then we have the big players, then we have the small players. Okay, so the big players are these banks, hedge funds, okay, these people who actually move the market, because you and me, we are just small fish in the ocean of the market. Why? Because the Forex market is actually a $1 trillion market. Per day we have volumes of trillions of dollars that are being traded daily. So if I trade daily something like $1,000, I don't have any impact on that market. The people who have an impact in that market are the big people, the big players, these hedge funds, this institution. Okay, so for you now to be successful, you have to see and learn what are the big players doing in the industry. Okay, what are the big players doing in the game? So that's why it is very critical for someone to be able to learn about the concept of point of interest, and this is what we are going to cover today. So as I was saying, I said that these big institutions, whenever they have collected orders, then we entered maybe the manipulation phase, there's somewhere that price wants to deliver these orders to, and these places are where is what now we call the point of interest, and we shall be looking at this point of interest today. Okay, so this is the POI, this is the POI, this is the point of interest. So after, you see, when price reaches a point of interest, we have a very massive movement. Why? Because these are areas where these big institutions, these big players have placed their orders. I hope I'm clear up to that point. So having now an understanding of why it is important for you as a retail trader to be able to understand the concept of the point of interest, now let us look at this point of interest. What are some of these point of interest? Let's learn together, and I hope that at the end of this video you are going to have learned something. So we have 5 points of interest that I normally use, and those are the things that I'm going to teach only. I'm not going to teach you things that I don't use. So we have number one, we have a point of interest which is called a fair value gap. Okay, a fair value gap, a fair value gap. Okay, then another name for fair value gap, it's normally called an FVG. Okay, an FVG, an FVG. Okay, another thing that we have is what we call an order block, an order block. So we shall be studying each and every one independently so that we can be able to have a clear understanding of what we are dealing with. Number 3, we have what we call an all high purged. Sorry, an all high purged. which is OHP. Then we have number 4, old leopard. This is OLP. Then number 5, we have what we call a rejection block. A rejection block. So these are the point of interest where majority of these large institutions, these banks, hedge funds, they place most of their orders in these regions. So we shall be studying each and every point of interest independently. Okay, we shall be studying each and every one independently. So for today we are going to look at the fair value gap, and number 2, we shall also be looking at an order block, so that tomorrow we can cover other things. So start with the introduction to fair value gaps. So introduction to fair value gaps. So introduction to fair value gap. So what's a fair value gap? So a fair value gap, this is an imbalance in the market that happens. Let me just write that quickly. This is an imbalance in the market that is caused by sudden massive movement of price in the opposite direction, in one direction. So this is an imbalance in the market that is caused by a sudden massive movement of price in one direction. So I'll give you an analogy. I like giving analogies. So for example, we are in Kenya. So let's take, for example, if the price of petrol, okay, maybe the price of petrol shoots from 100 shillings all the way to 500 shillings. Okay, let's assume this was 100 shillings. Then this is 500 shillings. So what will happen to the economy, Mr. Koech? You can just unmute yourself and tell me. If today we get a report that the prices of fuel have shooted from 100 shillings to 500 shillings, what will happen to the market? The general market in
definitely.
Yes?
Yeah, definitely. Yeah, of course, definitely there'll be some shake-up
Okay.
in the economy because this fuel is a prime commodity.
Yes.
So we'll experience scarcity of fuel.
Mm-hmm.
Definitely.
Mm-hmm.
Yeah, by people hoarding so that they can sell at higher price.
Mm-hmm.
And it will affect everything, manufacturing. It will affect many things.
Mm-hmm.
So kind of an inflation.
So basically what you are trying to tell me is that there will be a lot of imbalance in the market, right?
Definitely.
Because the prices of everything will start shooting, and people will have, there'll be a lot of confusion in the market. So I think you can mute yourself now. So let me explain this concept of fair value gaps. So basically, when we have the market moving upwards, so for example, these are candlesticks, and the candlesticks are maybe bullish candlesticks because we are moving upwards. So if price, this is price now moving upwards. So we find that this is a very massive movement of price. Okay, let me use maybe blue to depict the bullish nature of price. So this is a very bullish movement of price. Like price is moving upwards with a lot of momentum. Okay, it's moving upwards with a lot of momentum. So you find that price normally doesn't move this way. Price moves in a series of impulses and corrections. So for example, this is an impulse, then these are correction, impulse, correction, impulse, correction. So why does price move this way? Because when price gives us this impulse, there's a lot of imbalance that has been left here. So price will have to come back and fill these imbalances, okay, before now price moves above. So we can look in this scenario over here. Let me just draw the wicks so that you can have a clear view of so we can see that this price is moving upwards with a lot of momentum, okay, it's moving upwards with a lot of momentum. This is a wick to depict the movement of price upwards. So price will never leave such kind of imbalances. So if you want to see where a fair value gap is located, you will see in a series of 3 candlesticks. So we have this as candlestick number 1, okay, let me just put that as the candlestick number 1. Then we have candlestick number 2, okay, this is number 2. Then sorry, let me just 2, I think that's clear. Then we have number 3, okay. So in 3 candlesticks, 3 consecutive candlesticks, number 1, number 2, number 3, if there's a gap between candlestick number 1 and candlestick number 3, in a way that if you want to draw a rectangle, for example, if I draw a rectangle from this wick over here to here, if I can draw a rectangle, that means that there's an imbalance, okay. We don't, price will never leave such kind of an imbalance, right? It will never leave such an imbalance because it will always have to come back and fill this imbalance before we have a push to the above, right? So what will happen is that price will come back again, fill this imbalance before have a push to the above. Let me give you this analogy of the economy of Kenya. So if the government wants to push the prices maybe of fuel to 500 shillings, first of all, it will push the prices maybe to 500. Then the people will complain and say, no, those prices are too high. Then the government will reduce the price, come back and fill the imbalance. Then now it will now increase the prices slowly by slowly because now people will have adjusted, okay. They will have known that the prices of fuel are going to rise, so they will be ready psychologically to be able to accommodate the rising prices of fuel. So the same thing also with these imbalances that are happening in the market. Price will have to come back to these levels, fill the imbalance that are there before we have a push to the above. So how do you identify a fair value gap? So I said that in a bullish scenario, price will never leave a gap between candlestick number 1 and number 3. So if you can draw a rectangle between candlestick number 1 and the wick of candlestick number 3, the wick of candlestick number 1 and the wick of candlestick number 3, that is a fair value gap, okay, that is a fair value gap. But in a scenario whereby if this wick, you can see this wick over here, if this wick came all the way to this point over here, let me just draw it further. If we try to draw a rectangle, you can see clearly we cannot draw because this price came back and filled this imbalance that was here. I don't know if you are understanding what I'm saying. Price came back again, filled this imbalance, then it pushed above, meaning that there is no imbalance. But even if it's this small and I can draw my rectangle, okay, you see, if I can draw my rectangle, the wick of number 1 and the wick of number 3, if I can draw a rectangle, that means that there is an imbalance in that price, okay. Are we together? That's for a bullish scenario. Any question?
That's okay. That's fine. No. It's okay. It's
So
flowing.
let's look at a bearish scenario. So for a bearish scenario, it's just the same thing. Just that this now in a bearish scenario, we say that price is moving downwards. Price is moving downwards. So we may have price moving downward like this. So what will happen is that if we have this candlestick, this is a candlestick that formed. This is a candlestick that formed. Number 1, then number 2, then number 3. Okay, that is it. So I don't want to draw the wicks because because of the viewers on YouTube. Let me just draw them. So we have that number 1, number 2. So the wick between the candlestick number 1 and the candlestick number 3. So The reason why my candlestick number one is this one above is because now we are bearish and we are moving down. But this one was a bullish scenario and we're moving upwards. That's why we started our candlestick number one from the below. So let's look together. If price is moving downwards, price there should be no gap between this week and this week. If we can draw a rectangle tool between this week and this week, that means that there is an imbalance, right? That there is an imbalance. But if we have this week maybe coming this way and maybe you have this week coming this way, in a way that if I try to draw my rectangle, okay, if I try to draw my rectangle in this point over here, I can see clearly I can't draw. No, in this scenario I have imbalance. Maybe in this scenario over here you can see price completely filled the imbalance, so we don't have any imbalance. In that scenario we don't have a fair value gap, right? So let's look at examples in the chart so that we can be able to have a deeper understanding of what we have just learned. So this is a bearish scenario. Price is really dropping, and we say that if price is moving downward, we say price is bearish, and we can say it's also a downtrend. Okay, so let's look at three candlesticks and see if we have any imbalance. So we have candlestick number 1, number 2, number 3. So if I try to draw my rectangle between the wick of candlestick number 1 and the wick of candlestick number 3, sorry for this, let me just delete that one and zoom in so that we can be able to have a better view. All right, so this is candlestick number 1, number 2, number 3, because we are bearish. So we have a fair value gap in that point over there. Okay, let's look at another example. Candlestick number 1, number 2, number 3. If I draw my rectangle between the wick of candlestick number 1 and the wick of candlestick number 3, Mr. Koech, can we really say that there's a fair value gap at this point? This is candlestick number 1, this is number 3. I'm trying to draw my rectangle tool, but you can see this, it cannot, it's just a straight line, meaning that all the imbalances have been filled, right? Let's look at another scenario. We have number 1, number 2, number 3. I think you can unmute yourself, Mr. Koech, so that you can be able to
they are
together. All of these are filled. Let's look at a scenario whereby we have this one over here. This is number 1, number 2, number 3. Let's look if we can draw. Yes, we have an imbalance over there. That is a fair value gap. So let's look at this scenario. This is a bullish scenario. Number 1, number 2, number 3. Can I draw my rectangle tool between the wick of number 1 and number 3? Yes, we have an imbalance over there. Price will definitely have to come back and fill that level. Let's look at this one. We had number 1 and number 3. There's no imbalance over there, because you can see price came back, filled that imbalance, and then we had that push to the above. Let's look at this one. Number 1, number 2, number 3. We have this one as our fair value gap. You can see price came back again, tapped on it, and we had a reaction above. So I'll urge you to continue doing more practices on the fair value gaps, and I'll want you to send me at least 3 examples of fair value gaps that you have been able to identify on your own, so that I can see your progress and see if you are understanding these things, or we should put more effort in learning. So at this juncture, I want to welcome any question that you may be having.
Okay, I don't have any question for now.
Okay.
Yeah.
So if we don't have any question, I want to thank you for joining this session. And guys, if you have gotten any benefit from this video, kindly like the video, comment on the video, so that the video can also be shown to other people who can also benefit from the same information that I'm giving out. For those who are outside Kenya, if you want to get access to me, my number is +254 790 977 827. Reach out, tell me that you want to learn about trading, and I'll be able to help you and learn together, as we desire to end the year having been successful in the market. Thank you for everyone who has watched this video. Be blessed and have a lovely evening.
Okay.